Booms are built on expansion, busts are built on contraction. But beneath every major financial cycle lies one powerful force that rarely makes headlines: leverage. Leverage amplifies outcomes. It accelerates growth in good times and destruction in bad ones. It allows corporations to expand aggressively. Governments can stimulate economies beyond current revenue. Investors control larger positions than their capital would normally allow. Households purchase homes and assets long before they could afford them outright. Leverage is not inherently reckless. It is a tool. Modern economic growth would look very different without it. But when leverage accumulates across an entire system, something fragile begins to form. A deleveraging cycle begins when accumulated borrowing must be reduced. It happens when debt levels become unsustainable relative to income, asset values, or interest costs. It occurs when credit conditions tighten, asset prices fall, or confidence weakens. And once it begins, deleveraging is rarely smooth. To understand the Great Deleveraging, we must understand how leverage builds quietly. During periods of low interest rates and stable growth, borrowing appears rational. Companies issue bonds to fund acquisitions. Investors borrow to amplify returns. Governments finance deficits cheaply. Banks expand lending. Rising asset prices reinforce confidence. Collateral values increase. Risk models show declining volatility. Credit spreads tighten. The system feels stable. But leverage does not disappear when conditions shift. When interest rates rise or asset prices begin falling, balance sheets change. The value of collateral declines while liabilities remain fixed. Debt-to-asset ratios increase automatically. Lenders reassess risk. Margin requirements rise. Credit lines tighten. Borrowers may be forced to sell assets to reduce exposure. Forced selling puts downward pressure on prices. Falling prices reduce collateral values further. This triggers more margin calls. More selling follows. The process becomes self-reinforcing. This is the essence of deleveraging, a feedback loop between asset prices and debt levels. The Great Deleveraging refers to system-wide contraction rather than isolated defaults. It involves households, corporations, financial institutions, and sometimes governments reducing leverage simultaneously. Instead of borrowing and expanding, they prioritize repayment and balance sheet repair. Instead of investing aggressively, they conserve liquidity. Risk appetite declines across the board. The macroeconomic effects can be severe. When households reduce debt, consumption slows. When corporations focus on debt reduction, capital expenditure declines. When banks tighten lending standards, credit availability shrinks. Economic growth weakens not because of a lack of potential, but because balance sheet repair takes precedence over expansion. Monetary policy attempts to counteract deleveraging by lowering borrowing costs and increasing liquidity. Lower interest rates reduce debt servicing burdens. Asset purchases stabilize financial markets. Liquidity facilities support funding markets. These measures can slow the pace of deleveraging, but they cannot eliminate the need for balance sheet repair. The challenge arises when deleveraging becomes synchronized globally. In an interconnected financial system, stress in one region can transmit quickly through trade, capital flows, and financial exposures. Multinational corporations face funding pressures. Banks with cross-border operations reduce lending simultaneously. Emerging markets dependent on foreign capital experience outflows. The contraction spreads. Deleveraging also shifts investor psychology. During expansion phases, risk is perceived as opportunity. During contraction phases, risk is perceived as threat. Investors seek safety. Demand for government bonds may rise. Equity valuations compress. Credit spreads widen. Volatility increases. The system transitions from risk on to risk off. Importantly, deleveraging is not merely about debt reduction. It is about confidence recalibration. The assumptions that justified high leverage are questioned. Market participants reassess what constitutes sustainable risk. Business models reliant on cheap financing face scrutiny. Asset valuations tied to perpetual liquidity expansion adjust downward. History shows that deleveraging cycles can last years, not months. After periods of excessive borrowing, balance sheet normalization requires time. Households rebuild savings. Corporations restructure obligations. Banks strengthen capital buffers. Governments reassess fiscal trajectories. The process can feel slow and frustrating. This is particularly compared to the rapid acceleration that preceded it. There are different forms of deleveraging. Orderly deleveraging occurs gradually, supported by policy coordination and moderate growth. Disorderly deleveraging involves sharp asset price declines, credit freezes, and systemic stress. The difference often depends on timing, policy credibility, and the scale of leverage entering the downturn. One of the most important dynamics during deleveraging is liquidity preference. Market participants prioritize cash and highly liquid assets. Even fundamentally strong investments may be sold simply to raise liquidity. This can create price dislocations where asset values temporarily detach from intrinsic fundamentals. Corporate behavior shifts noticeably. Companies reduce share buybacks, delay acquisitions, and prioritize debt repayment. Hiring slows. Cost-cutting measures increase. Defensive sectors may outperform cyclical ones. Financial institutions strengthen reserves and reduce risk-weighted exposures. The Great Deleveraging also reshapes long-term economic structure. Industries built on speculative growth may contract permanently. Capital reallocates toward more sustainable sectors. Regulatory frameworks often tighten in response to perceived excesses. Financial innovation slows temporarily as caution dominates. However, deleveraging is not purely destructive. It resets imbalances. It restores discipline to capital allocation. It clears unsustainable projects from the system. It reestablishes risk pricing that better reflects underlying fundamentals. In this sense, deleveraging, while painful, is part of economic renewal. The true risk lies in denial. If policymakers or market participants resist acknowledging leverage excesses, adjustments may be delayed and amplified. Suppressing deleveraging indefinitely through artificial liquidity can create larger distortions later. The longer leverage expands unchecked, the more dramatic its contraction tends to be. Modern economies face elevated debt levels across multiple sectors. Governments carry significant sovereign obligations. Corporations have accumulated substantial bond issuance. Households in many regions hold mortgage and consumer debt. Financial markets are interconnected through derivatives and funding channels. These conditions mean that future deleveraging episodes will have systemic implications. The Great Deleveraging is not a forecast of collapse. It is a recognition of cycles. Expansion and contraction are structural features of credit-based systems. The question is not whether deleveraging will occur, but how severe it will be when it does. Leverage builds prosperity quickly. Deleveraging rebuilds resilience slowly. In a world that has grown accustomed to constant expansion, the discipline of contraction may prove the greatest test of all. Welcome to Cash and Chronicles, where money, power, and history collide.